Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. In our first weekly briefing of the year, our analysts discuss with Suhaimi Ilyas, Chief Economist, on factors that will support ASEAN markets and potential headwinds.
Hi everyone, Happy New Year and welcome back to our weekly Monday GP call. We have plenty of speakers this morning, 9 to be exact, to cover in this 30 minutes window. Harbin, Joey and Zamros will speak on Singapore, Indonesia, Thailand and Philippines macro, specifically on growth, inflation and central banks' interest rate policy. Then we have Anand, Tilan, Jeff and Boy, who will go through with us this morning on Malaysia, Singapore, Indonesia and Vietnam's equity outlook and strategy for this year. After that, Winston will talk on Malaysia's credit market outlook for 2023. Last but not least, we have Cheating with us this morning to speak on the thematic for Malaysia plantation sector. So without further ado, let's get the ball rolling with Harbin. Harbin, Singapore's fourth quarter 2022 GDP growth was basically half the pace of growth in third quarter last year. Can you run through what caused the growth slowdown and also share with us your thoughts on 2023 growth outlook for Singapore?
Hey, hi, morning, Suhaimi. Yeah, so Singapore's growth slowed in the fourth quarter to just 2.2%. That's down from the 4.2% in the third quarter, and that is probably the slowest pace, since the first quarter of 2021. And I guess there's a big divergence here. It's really because of the manufacturing, which is contracting by about 3% in the fourth quarter, and services growth is still holding up pretty well. There's some slowing down in trade-related services like wholesale trade, transport and storage, but essentially all the reopening sectors are still holding up the services side. So, I think this divergence is going to become even more stark this year, where the manufacturing recession will probably continue for the first half of the year, but services growth will probably hold up fairly well, as the reopening sectors continue to recover, and with some support as well coming from the China reopening. So for this year, we're looking for growth at 1.5% within the government's forecast of 0.5 to 2.5. We think it will feel more like a half full rather than a half empty economy, essentially because I think the job market is still pretty tight, and that's still probably going to support wages and some of the services sector, which is accounts for a larger share of employment than manufacturing. Bear in mind that this year as well, the GST has just been hiked, but the government has actually introduced an 8 billion assurance package, which actually has been raised several times. And when you think about 8 billion spread over 5 years, in the first year, that's probably as large as the tax receipts collected from GST itself in the first year. 1% GST collects about 1.8 billion. The government's giving out 8 billion back. So I think the GST will probably bite only in the second year when we have the full 2 percentage points increase. Our forecast also takes in sort of a kind of gradual China reopening, but clearly it's moving a lot faster than we thought. So a very rapid and smooth reopening could offset some of the weaker growth in US and Europe, and probably provide some upside to the growth numbers as well. Lastly, I think the MES decision still a bit of a dilemma because core inflation is still very sticky at 5.1% in November. We're expecting to come down, but it looks like it's probably going to be sticky downwards. Bear in mind that besides the GST hike, the rents will probably stay high because of a housing shortage. The government has expanded progressive wage model to more sectors, including food services, waste management, and occupational services. So that's going to provide some pressures on wages as well. So we're looking for the MES to tighten again at the April meeting, probably via a recentering of the same-year exchange rate.
Hey, thanks, Harbin. Let's move on to Joey and Zamros. Indonesia, Thailand, and Philippines released their December 2022 inflation rate. Basically, there's sort of three questions here. Number one, have inflation peaked and slowing, or are they still persisting and being sticky? Number two, how do both of you see inflation trending in 2023 after what happened in 2022? And thirdly, what are your outlook on Bank Indonesia, Bank of Thailand, and BSP's interest rate policies? Ladies first.
Morning, everyone. For Indonesia and Thailand, headline inflation had already peaked in the third quarter of last year and have been easing in recent months. So as of December, Indonesia CPI eased to 5.5% from 6% in September, and Thailand to 5.9% from 7.9% back in August. This is because food prices have been coming off quite considerably. And for Thailand's case, fuel prices have also been easing with the moderation in global oil prices. But inflation in both countries are still well above their central bank's target range of 2 to 4% in Indonesia and 1 to 3% in Thailand. For 2023, we expect inflation in these countries to come back to within the central bank's target range in the second half of this year as the high base effects kick in. For Indonesia, I'm looking at headline CPI to average 4.2% this year, while for Thailand at 3%. Core inflation in the two countries are still rising, but at a very gradual and slow pace. In terms of the interest rate policy, I'm looking at BI to deliver another 25 bips to 5.75% in this upcoming meeting on 19th January, and followed by another 25 bips hike in the first quarter. BI may be entering the late stage of its tightening cycle. The focus seems to be shifting to supporting growth amid a weakening global outlook. On the other hand, BOT, I also expect another 25 bips hike for the fourth straight meeting on the 25th of January. That will bring the policy rate to 1.5%. The BOT stated in the last meeting in December that it expects to keep raising interest rates through the first half of 2023. Our base case is for the BOT to hike once this year, but a faster economic recovery with China's reopening may allow one more rate hike and bring the terminal rate to 1.75%.
Thanks, G. Zabros, you want to continue on Philippines?
Hi, good morning. 8.1% headline inflation for Philippines in December. It's the highest for 2022. But we think that for the cycle, we think that headline inflation going to be very close to the peak, meaning that if December 2022, 8.1% is not the peak, we expect the January numbers will be the highest for the cycle. For this year, we expect the gradual downward trend. We only expect we only expect the headline inflation to go down to reach the upper end of BSP's target range of 4% by the third quarter of this year. With the 8.1% headline inflation in December, we raised our full year forecast for this year to 4.6% from 4.3%, mainly because of the expectation of the fourth quarter 2022 growth GDP to be better than expected. Then also the lingering effect from the natural disasters from the typhoon Kading and tropical cyclone Paing that going to push up food and non-alcoholic beverages for this year. So with that, with the higher inflation forecast for this year, we expect BSP to add another 50 basis point of policy rate in the first quarter of this year to push the policy rate to 6% for this year. So I mean.
Thanks, Jui Zambros. And just to highlight to our listeners this morning, our macro view for this year is, in a sense, a continuation of this high inflation, high interest rate environment for much of this year after last year. So on that note, I think it's quite nice for us to move to the fixed income side of things. Vincent, you shared with us the comprehensive 70+ chatbooks on Malaysia credit outlook for this year, which is also published as ASEAN Macro for this week. I mean, can you distill the chatbook, the report, into key highlights, views, and takeaways for the benefit of our listeners this morning?
Hi, good morning, Suhaimi. Yeah, I will summarize the key takeaways in two parts. Firstly, supply and demand, and second, for credit conditions and credit spreads. So for supply and demand, Malaysia's corporate bond market had a bumper year on issuance with total supply of 130 billion in 2022. Based on our compilation, it was mainly driven by more supply on bank capitals, Chakamas bonds, toll road restructuring and refinancing. But for 2023, we forecast lower gross issuance of 110 billion. We do expect healthy issuance of infrastructure and utility bonds to fund the ongoing real projects and pockets of renewable independent power producers. Banks are well capitalized, so the issuances should be mainly for refinancing. Sustainability bond supply has increased, and the total outstanding amount currently account for about 3% of the total corporate bond market. And I would say, interestingly, the net government guarantee bond issuance has dropped substantially last year, with a net redemption of 2 billion compared to historically average net supply every year is about 20 to 25 billion. And I think the issuance for so-called GG bonds could actually still remain benign in 2023. And coming to demand, we think it's going to improve because last year was a very challenging year. Asset management companies face redemption pressures and banks' appetite probably constrained by mark-to-market losses, but we expect this to improve. For credit condition and credit spreads, the rating migration trend where we compare the ratio of upgrades versus downgrades and also outlook increase versus decrease has been roughly balanced between the positive and negative actions. So just briefly on some of the sectors that we have reviewed, we are neutral on construction, banks, independent power producers, while expecting additional upgrades in the plantation sector. Property is a mixed bag, largely stable, but rating action overall could be slightly negative bias. So coming to credit spreads, we expect a moderate 10 to 20 bip widening on average, mainly driven by MGS outperformance, and also we impute a mild spillover from the risk of US recession. And typically, ringgit credit performance, they have a low correlation with external credit markets, provided there's no hard landing. So from a top-down bond allocation angle for credit bonds, we would recommend a defensive credit positioning, preferring to get yield from high-quality duration. I'll stop here.
Thanks, Winston. Just an aside, can you remind us of your expectations on US Treasury and MGS 10-year yield outlook for this year?
Yeah, in general, we expect the yields in these two markets to fall. We forecast 10-year US Treasury yield to fall below 3% by the end of 2023. And for Malaysia 10-year MGS, we expect yield to fall towards 3.5% by the end of this year.
Thanks, Winston. Next, we have the fearsome foursome of Anand, Dylan, Jeff, and Hui. Mixed fortune for Malaysia, Singapore, Indonesia, and Vietnam's equities last year. Gains in Singapore and Indonesia, decline in Malaysia, and actually slump in Vietnam. What about this year? How should investors position in these markets? I mean, can we start with Anand on Malaysia first?
Good morning, guys. So I think for 2023, we are being a lot more sort of positive on the market outlook for Malaysia. I think two things have changed compared to 2022. The big one is obviously, the outcome of the general elections in November. So now we have in place a fairly solid unity government, which has a reformist sort of agenda as well. And provided, the government sticks together and they start to pass policies relatively seamlessly, the political risk premium, which was a big reason why Malaysia underperformed in 2022, should start to decline. And that will support higher multiples for the market. Now, what do those multiples apply to? They apply to earnings, obviously. And there's good news there as well. Compared to 2022, where market earnings were really handicapped by Cukai Makmur, that one-off prosperity tax, as well as fairly laggard recovery for some key heavyweight sectors like casino gaming and transport aviation. 2023 is broadly much brighter on all these scores. The no longer Chukai Makmo, transport, aviation, casino, gaming, we see a much faster earnings recovery this year. And that could be even faster if China's reopening proceeds faster than expected, obviously. So overall, market earnings growth this year on a headline basis, 16% compared to -2% in 2022. So those two factors, I think, make us quite positive. Our KLCI target is 1660, which is about a 14% upside from end 2022 closing.
Across the causeway, Dylan, what about Singapore?
On Singapore, I think one of the key things to kind of look at is a lot of the news flow has been dominated by, Russia, inflation and all that. But within that, we did actually see quite a few positive developments, particularly in areas like banking, where we saw more and more artificial intelligence being used for commercial use cases. We also saw things like big data, 5G being used across different sectors. So I think from that perspective, when we take a slightly longer term view across the Singapore market, there are some particularly promising candidates to look for, particularly in areas like banking, telecom, as well as in the healthcare sector, as well as industrials. We've got about 10 stocks that we have as top picks for the sector, including the 3 banks, as well as Bumita Agri, some of the tech names, as well as Raffles Medical.
What about Indonesia? Jeff, can you highlight to us what's your expectation for this year?
We are quite cautious for this year, especially the first half. If we look at what made Indonesia interesting last year is because of the commodity boom. That narrative is already gone. But we still think that there will be a boost from the pre-election campaign spending for this year. For this year, we cut our 2023 index target to 7,600, which still have around 12% return. We think that we recommend our investors to be cautious and due to weaker GDP growth forecast and also normalizing bank profits. For our coverage, we prefer to go long on the consumer staples names like ICBP, Mayora, and also a high dividend yield paying telco operator Telkom. And we also like EV battery narrative. We prefer giant metal miners like Inco and MDKA or Merdeka Corp. And we also recommend to buy big banks, BBRI and Mandiri on weakness. Overall, our message is that stay agile, remain tactical, and focus on the liquid and high dividend paying stocks while waiting for the Fed to pivot.
Hui, what about Vietnam? Bottom fishing or still a wait and see?
Thanks, Suhaimi. I think bottom fishing. Well, just look back a little bit. In 22, the index fell from its all-time high of 1,500 points due to FX, a global headwind, and bond market turmoil, country-specific headwind. In 23, inflation, we think, is replacing FX to prolong the tightening cycle of monetary policies. In the first half, we will likely see inflation to stay elevated and monetary policy to remain tightened. Meanwhile, the bond market growth, which caused a liquidity crunch in the last month of last year, would force developers to accelerate the leveraging this year. So we take inflation and corporate bond market downturn at the center of our 23 outlook. So, and we generally expect a tough year ahead, but we should see positive factors, including pro-growth government, China's reopening, strengthening foreign inflows, and especially the ones in a decade low valuations as a potential game changers this year. All in all, we expect to see more volatility in the market and then consolidation in the first half due to declining EPS and shrinking liquidity. But the market will likely, would form a clear recovery in the second half this year because of the easing monetary policy to support the economy. So in our base case, we expect EPS to grow around 7%, and we invest to gain 25 to 30% to reach around 14 points this year. We recommend sectors with resilient earnings growth and attractive valuations. We focus on IT, beverage, energy, industrial park, and banks.
Cool. Just very quickly, there seems to be a lot of headlines on the political situation over there, given the crackdown on officials over corruption and all that. Can you shed some light in terms of what's going on there and whether there is going to be an impact on the market?
Well, the anti-graft campaign actually happened since 2018. It intensified this year through the crackdown on corporate bond market, and in the fourth quarter last year, we see liquidity crunch from developers because they, in the past few years, bond market has emerged to be one of the main important funding source for developers. Total outstanding bond is around $50 billion, equivalent to bank credit to developers. So it's a very important source. But the point is that retail investor hold too much. Their participation is maybe up to 2/3 of total bond outstanding, and it's a dangerous level. So that's why many just low quality developers also jump into this market, and it's a very dangerous situation for the macro stability, and that's why the government step in and crack down the market in 2022. And so we see a liquidity crunch last year, and this year it will transform into deleveraging of developers, and that's why we think we expect a downturn of real estate market this year, and that will impact the overall stock market.
Thanks, Hui. Circling back to Thilan, we have this Fengshui guide to prosperity for the water rabbit year this year. What are the zodiac, the elements, the stars are saying on investing this year?
Our work with Master Ken Ko is predicting gentle transformation for the markets this year, with a bit more stability than last year. More confidence is expected in the equity markets after May, but not all markets will be equal. The guide is more positive on the US, Singapore, Thailand, and Indonesia for this year. On China, while the current reopening euphoria and it notwithstanding, the expectation is for a much more gradual growth for this year. Malaysia is also expected to face some more economic headwinds in 2023. From a sector perspective, metal and earth industries are set to be the immediate winners, while fire industries will be stronger towards the second half of the year. Some of the sectors to watch out for and be positive on include banks, industrials, property, agriculture, brokerages, telecom, and energy. On a personal level, the zodiacs with the highest luck for this year, if that's something of interest, is the rat, dog, and goat.
Right, thanks, Thilan. For the listener, do read that piece just to get some tips from Feng Shui masters about this year. From something cosmic to a bit more down to earth stuff on Malaysia plantation sector. Chiting, your note on M&A activities. How has 2022 panned out, and how do you see 2023 playing out?
Good morning, Suhaimi. 2022 has been a rather quiet year for M&A activities among the planters, both in terms of volume and also value. The M&A transacted value in 2022 fell by 77% year on year to just about 1 billion from 4.3 billion in 2021. But recall that 2021's M&A was largely boosted by the privatization of IGM Plantations by KL Kapong. Now, the slowdown in the M&A activities in 2022 could be due to the high CPO prices, which hit historic high in March of 2022, that led to the potential sellers asking for unrealistic prices. What we observed was 2022's M&A activities appeared to be less focused on brownfield oil palm expansion acquisition, but more concentrated on land banking for other purposes such as property development and infrastructure development projects such as solar farms. The most notable M&A deal in 2022 was the proposed sale of freehold land in Kapar, Selangor by Sime Darby Plantations to Sime Darby Property for 618 million cash, or in terms of value per hectare is 1.6 million ringgit per hectare. The high transacted price, which is at 25 times higher than the average physical transacted prices of oil palm company or oil palm estate, about 65,000 ringgit per hectare, was due to the property development potential at Kapar itself. Now, for 2023, we believe the M&A activities are poised to pick up momentum if CPO price stays at or below 4,000 ringgit per ton price levels. Now, compared to the average transacted physical price of oil palm estates of 65,000 ringgit per hectare for the period of 2021 to 2022, small to mid-cap plantation companies appear undervalued, as they mostly trade at enterprise value per hectare of just between 14,500 ringgit to 35,000 ringgit per hectare, which are or at below their replacement costs. Replacement costs, we estimate, are now between 30,000 to 45,000 ringgit per hectare. So valuations have become more compelling for planters, especially those with strategic land bank that offer alternative use, such as property development. In terms of stock picks, undervalued small to mid caps such as Bowster Plantations and Ta'an offer attractive value propositions. And further within the broader sector, we believe Hap Seng Plantations, which we don't cover, remains a prime privatization candidate. Hap Seng Plantation trades at an attractive EV of about 34,000 ringgit per hectare, price to book only 0.8 times, and with a net cash of 54 cents per share.
Right, thanks, Chiting. I think on that note, we can wrap up today's first call for the year 2023, and that's it for today. Thank you very much and have a good week ahead.
As always, get specific advice from your trading rep and check out our research reports on the Maybank Trade platform. Also follow us on Spotify or Apple Podcasts. I'm Noelle Lim on ASEAN Speaks by Maybank.